Well, hey there, everyone. Happy Wednesday. Happy Hump Day, December 3rd. I'm Dave Keller, and welcome to our daily market recap show, Chart This with Dave Keller. We're coming to you from a classic December day here in Redmond, Washington. A little chilly, a little damp, a little overcast. Lots to be happy about. Hope you guys are staying happy and joyful and hanging in there wherever you're tuning in from. Thanks so much for watching me and following my work. I hope that it helps you navigate these markets. Hope it gives you some ideas, some context, and just educates you on the power of technical analysis and behavioral investing tools, which is what I've spent my career learning about, teaching about, and using to help people improve their market awareness. Today, we're going to talk about the S&P's continued push higher, still sort of within the range we've been in for the last week or so, but just starting to incrementally move higher. Today, it was less about sort of the growthy technology trade. Today was a little bit more about energy, other sectors, which means the Dow outperformed the NASDAQ, which we haven't seen a ton. The S&P 600 small cap index outperformed the S&P, the NASDAQ, the Dow, and all the other major U.S. indexes. Cryptocurrencies continue to recover a bit. A lot of charts to talk about. As always, we'll start with a recap of market conditions as they played out here on Wednesday, December 3rd. We'll look at the heat map, which is a great way of visualizing sort of big picture to small picture, macro to micro. We'll talk about some of the themes in the equity space today. And I've hand-selected a group of charts to highlight for you. We're going to talk specifically about some of the Magnificent Seven stocks here, because if you're all excited about the market recovering this week, I don't blame you, right? Because it's been nice to see the major indexes going higher. But man, there are a lot of stocks that don't look great. A lot of stocks showing very toppy signs here. And I sort of maintain that that fact. There's a disconnect between what the major indexes appear to be doing and what stocks like Netflix are doing, which is not going up. What you'll find, there's a relatively small number of semiconductor names that actually had accelerations to the upside. That's helping the technical picture of the major indexes today. All right, let's talk about the markets here. As always, please put questions in the comments section on our YouTube channel. We're planning a mailbag episode on Friday. We've got some really good questions already queued up for you. Please throw your questions in. We'll get to them as soon as we can and share some insights based on what you guys are asking about. S&P up about 0.33% today, closing just below 68.50. It was up just about 68.60 around about an hour before the close. Last hour was a weaker hour. We saw that sort of late stage sell-off yesterday as well. I mean, it's not a great thing on the order of things to be excited about or nervous about. I mean, the last hour of trading is usually a good gauge of institutional flows because that's where a lot of institutions will be a little more active. So the fact that we're getting like a last hour sell-off, not great. It would be better if we didn't see that. Is that the most important thing I'm going to share with you? I don't think so. I mean, I think the general trend in the S&P, pretty good. The last week, though, stalling out. That's what we really haven't had a significant move higher, right? The VIX continuing to drift lower. So today, the VIX finished right around 16, actually briefly dipped below 16 in the afternoon. So with the VIX down in these mid-teens, what that's basically telling you is the options market's telling you that day-to-day movements in the S&P should be pretty low, right? Day up 0.3%, up 0.5%, down 0.3%, down 0.5%. That's what the options market is telling you, right? The volatility, it's pricing in lower volatility, which just means lower day-to-day movements. When the VIX spiked above 20, remember just in the last week or two, we saw day-to-day movements in like the 1% to 2% range. So VIX down in the teens means the options market's, pricing in that day-to-day movements are going to be pretty subtle, a little more nuanced, and that's kind of what we're seeing here this week. As I mentioned, S&P 600 small cap index up the most out of the major indexes here on page one, up 1.5% compared to the Dow's 0.9% and the Dow's 0.3, the S&P's 0.3%. So small caps surging higher. The sectors that did the best today are a big part of that story, I would argue. Looking at interest rates, my latest interview on the Market Misbehavior podcast, currently with my editor, Joanne Bianco of BondBloxx, came on the show yesterday. Had a great conversation about all things fixed income, different expectations about the Fed, about interest rates, 10-year Treasury yield, the dollar, bond ETFs and just different ways to get exposure, thinking of the income component of bonds, the stability, really interesting conversation. And again, as for me, as primarily an equity investor, fascinating to talk to someone who spent their entire career looking at the fixed income market. Just a very different area, right? Different style of investing, different focus on risk, a lot more than return generally. So I found it a really interesting kind of eye-opening discussion. I hope you'll enjoy that as well. Should be out to you guys tomorrow, I would hope. We'll see when we can get it all ready for you. Today, 10-year yields, as I discussed with Joanne, is a likely scenario. Rates continue to go down here, not by a ton, but getting lower. The 10-year yield down from 4.1% this week down to more 4.06. 10-year, long bond yield around 4.75%. The 5-year point around 360 or so, 362, we'll call it. Dollar down slightly, not a huge change, but is down a little bit from yesterday. The TLT trending higher today. Looking at the commodity space, kind of mixed here, although in the energy components, things like crude oil and natural gas actually had pretty decent days. The natural gas ETF was up over 3% today. Gold and silver basically unchanged from yesterday. The GLD and the SLV chopped around a bit, but basically not much change from yesterday. Soft commodities were down generally today. Cryptocurrency space, Bitcoin continuing to recover, right? It got below 90,000, got down toward the lows that we saw back in March and April. And we talked about sort of that general downside objective in the 75 to 80,000 range. Didn't quite get down there. Now we're seeing a nice bounce higher. That's encouraging, right? That you see this initial bounce. I think holding that 90,000 level, which we broke above yesterday, today we're holding it. That's all good. As we're recording the show here, Bitcoin is rotating higher above 93,000, close to 94,000 here currently. That's up about 3% from yesterday. Ether prices even better, up about 6%. All the top 10 coins, cryptocurrencies, tracked on the stock charts platform in the green today. Looking at sectors, only 2 of the S&P sectors were down, and utilities were only down 1/3%. Communication services and consumer staples were basically flat for the day. But on the top side, this is where you're seeing some decent gains in energy. The XLE was up 1.9%. In financials, the XLF was up 1.3%. Consumer discretionary, the XLY up 1.1%. So way more sectors up than down. 9 sectors advancing today. Technology, which is the biggest sector in the S&P and certainly the most, arguably the most important with the AI fueled frenzy that we continue to experience, only up about 1/4%. So really the gains today were in more value oriented sectors, specifically energy and financials. As we look at the breadth data, decent breadth today. Yesterday, the breadth was a little weaker. Today, not too bad, right? On the NYSE, you've got 71% of stocks up versus 27% down, about the same for the NASDAQ. The S&P 500, about a 2-to-1 ratio of stocks up versus down. In the small cap space at the bottom, you can see 78% of the S&P 600 small cap index in the green. So that's about a 3.5-to-1 ratio in the small cap space. So small over large is the story today. Value over growth generally was a decent bet today. So a bit of a change from some of the trends that we've observed recently. But what you're going to find here as we look at the heat map, 2 biggest gainers in the S&P 500 were semiconductor names. Microchip up 12%, On Semiconductor up 11%. Both of those kind of recovering above previous resistance and really moving to the upper end of the range that we've been observing here recently. Looking at the Magnificent Seven and friends, these leading growth names, Tesla at the top of the list. I feel like I haven't been saying that very often recently, but Tesla up 4.1% today. Alphabet, which has arguably been the strongest of these names, although in the last week, Alphabet really hasn't gone up much. It's been more sort of treading water, I would say, more than anything, from last week's shortened holiday week and through this current unfinished week. But today up 1.2%. Here's a problem on the downside. Netflix down about 5% today. I did grab that chart to share with you. Microsoft down 2.5%. I grabbed that chart as well. Meta also sideways. NVIDIA also sideways. So, a lot of the Magnificent Seven stocks, not a lot of them breaking out here. And a number of them obviously seeing some pretty significant drops today, even though the S&P and the NASDAQ were slightly higher. All right, let's look at the heat map. As a reminder, if you're watching the show here on our YouTube channel, please take a moment, ask a question. We'd love to hear feedback on the show, love to hear feedback on anything about what we're sharing with you, but very much would appreciate your questions. Gives us ideas about what sort of topics we can lean on in the days and weeks to come. Also, maybe we will feature your question on Friday's all mailbag episode. All right, looking at the heat map, I'm immediately drawn to the strength, not in technology, but the strength in financials. We haven't really seen financials, breaking out much. And I would say a lot of the XLF charts had been sort of choppy sideways. But if you look today, you're going to find Wells Fargo making a new all-time high, up about 3.5% today, finally breaking out of that range that it's been in. Morgan Stanley making a new all-time high today. This is after bouncing off of the 50-day moving average, breaking above 170, which is basically where we topped out in November. Goldman Sachs, who's some of the big investment banks, and you can see Goldman Sachs, just narrowly making a new high right at the upper end of that range, teasing 840 today. So impressive, because these are names that all pulled back in November. A number of these pulled back to like a 50-day moving average, now resuming the uptrend and pushing higher. Banks in charts like Goldman outperformed on the way off of the April low, particularly over the summer. But a lot of these kind of pulled back on a relative basis and now resuming that uptrend. The prices breaking out is encouraging. The relative strength improving, particularly on a chart like Morgan Stanley. I think the real compelling part of these charts, right? If you're concerned about a market environment, leaning into things that are outperforming is a tried and true way of kind of surviving and thriving through a period of market instability. So all the green that you're seeing on charts like Citigroup pushing above $100 a share this week. Some of the other charts that I shared with you, JP Morgan not quite making new highs, but bouncing off of support at 300. I think those are all pretty encouraging setups here. On the upper right, good to see industrials recovering as well. I think we shared UAL on Monday or Tuesday show. I forget where, but continue to push higher, very, very close to making a new 52-week high and really breaking above a significant level at 110. That's breaking above some of the previous closes from the beginning of the year, also from September. They all kind of topped out around the same point. Very, very close to breaking out. UPS is an interesting chart. I meant to grab this and I forgot to, so I'll just take a moment and show this. What's interesting about the chart of UPS has been languishing below the 200-day moving average for over a year and a half, and this has been in a clear downtrend phase. We've had a number of kind of blow-off moves above the 200-day moving average, and going back, you can see that that's pretty much where the buying power has been exhausted, and the chart starts to rotate lower. Just in October, we finally gapped higher and got back to the 200-day moving average, settled into this sort of consolidation phase, and now breaking more to the upside. So UPS very close to making a new swing high and getting above $100 a share. Now, what I did here, just because as I'm talking about it, remember, look, because the prices come down so much, dividend is pretty decent here, right? Pays a decent dividend. So the forward dividend yield is up around 6.5% to 7%. That's way above the average in the S&P. Definitely considered a higher yielding name here. So when you have a stock that has a dividend yield that's so significant relative to its stock price, you really want to consider using an unadjusted data series, which basically means you're just stripping out the dividend adjustments and looking purely at the price action going back. What you find there, and the way you can do that on stock charts, add a little underscore before the ticker or down here below the chart. This is going to be by default selected. You want to deselect adjust for dividends. If you use another charting platform like TradeView or Optima or any of the innumerable other things, Bloomberg or some random thing, most charting platforms I'm familiar with give you the ability, at least the good ones, give you the ability to adjust for dividends or not. You may not know what the default is. You can kind of look into it, and each of them has a different way of describing it and allowing you to select it. But on stock charts, I often toggle back and forth between them because there are just certain times when you want to include dividends or not. With a higher yielding name, just looking at the price action, sometimes taking the adjustments off can be helpful. When you do that, you can see that today UPS finally closing above its 200-day moving average. The question is, does it hold that gain, right? Does it hold above the 200-day? Breaking above 100 would clear the October swing high, and I think be a very bullish development for a stock, UPS, that has been struggling here. Obviously, trading below the 200-day moving average for quite some time. What else do I want to talk about on the heat map? Kind of a mixed bag in the healthcare space, to be honest with you, compared to like financials, which kind of generally look positive. Within the healthcare sector, some of the names that have been doing so well, like Eli Lilly, for example, which, notably enough, Eli Lilly, just above a trillion market cap. And if I remember right, one of the first non-technology kind of internet names to get above that threshold, but in the last week, rotating back below there to get above $1,100 a share, currently teasing $1,000 a share. Big round number. The 21-day EMA is right there. So it's kind of pulling back to a level of tactical support. If this is just a brief pullback, the 21-day EMA is usually a pretty good place to look for an upside reversal. That's what I would have as an initial sort of a downside target in a pullback. We get much below 1,000. All of a sudden, it doesn't look like a tactical pullback, and it looks like the beginning of something more significant. So Eli Lilly kind of pulling back to that, that important level. But just note within healthcare, something's up a lot, something's down a lot. It was actually a pretty diverse sector today. Same in communication services. Alphabet higher, as I mentioned, but like Meta and Netflix down, and Netflix, I think continues. Meta and Netflix are the two least impressive charts within that kind of Magnificent Seven and Friends, and I think Netflix now reasserting its hold as the worst chart out of that bucket. Industrials generally looking pretty interesting. I mentioned some of the airlines, energy obviously bouncing higher as well, and oil companies, energy companies have been bouncing around a bit here recently, of course. But when I'm looking at ConocoPhillips, like I'm starting to see an improvement similar to UPS. ConocoPhillips has been below its 200-day moving average for quite some time. It's had a number of attempts to get above the 200-day moving average, and then it hasn't held. So we have a scenario where some of these charts that have been lagging, where the relative performance is weak, some of these charts that have been trending lower below downward sloping 200-day moving averages, in some cases for months and months, if not years, a change of character to this market will be charts like COP, charts like UPS, rotating above the 200-day and changing. And then my question is going to be, are other stocks that have been in primary uptrends, are they rotating lower? And that's where charts like Netflix come to mind as some previous leaders that are now starting to struggle. Those are some thoughts looking at the heat map here. We're going to look at the charts in a moment, but as a reminder, Black Friday sales, a lot of them are kind of dribbling through the week here. I know that folks at Seeking Alpha are keeping theirs going through the end of this week. If you go to marketmisbehavior.com/alpha picks, you can find information about their alpha picks product. You can also go to marketmisbehavior.com/seeking alpha to look at their regular premium memberships, which allow you to get to some pretty cool, research that they provide, but also advanced uses of their quantitative model, their scanning capabilities. There's also a bundle where you can combine the two. Go to marketmisbehavior.com/SA bundle for Seeking Alpha bundle. All three of those links will give you a pretty good deal. All of those are being offered at 20% off for your annual subscription this week for Black Friday. So check out those links. It definitely helps me keep Market Misbehavior awesome. And thanks to the folks at Seeking Alpha being good long-term partners of the channel. All right, let's look at some charts together, shall we? We'll start with the daily chart of the S&P 500. I mean, not a bad thing that the S&P and NASDAQ are closing higher, as is the Dow today. We're sort of seeing a continuation of the rally that we saw last week. The kicker was that was a shortened holiday week. So I'd sort of thought, listen, that could be a lot of noise just because of the normal holiday movements. Let's wait until this week to see if that uptrend persists. What's interesting, though, I mean, if you look at the chart of the S&P, and, I'm zooming in just a little bit, I mean, this week so far, I mean, this was Friday's day. Here's Monday, Tuesday, Wednesday. I mean, they're literally the same price range. So, I mean, the trend in the S&P, at least just in the last couple of days, we really haven't continued. This is what happened last week. This is what's happening this week, right? 1 week is a clear uptrend week. This is more of a sideways week. Now, we're very close to kind of emerging and strengthening from here. But not there yet. We're kind of still treading water above this trend line, which is a pretty encouraging sign. And I had one of my premium members asked about the S&P and just how to think about it. My comment was, look, I'm kind of thinking of the S&P like a stoplight here, and I'll give you. I mean, hey, it's my show, so I'll jump in a bit. I'll give you kind of the general idea of what I was thinking. I mean, I think of charts, generally speaking, I like to think in a stoplight kind of format, a traffic light. And what I mean by that is it's really helpful to just think. I mean, look, if my goal is to, find things that are strong and follow them to additional strength, then, oh Lord, I am making such a hot mess of this. Okay, let me try that again. Sorry, I'm trying to multitask talking and adding annotations. Clearly, I can only do one of those very well. So here we go. I'm going to describe what I'm doing. I can pretty much do that, I think, with my eyes closed. Let's hope. So we've got the positive stoplight. We've got the neutral light, which I would put out as kind of there. We'll call that kind of neutral orangish. And then we're going to copy this guy and say, whoops, we're going to copy this guy and say, yeah, like so here, that's sort of your red light. So what have I done here? What I'm basically saying is, look, the S&P is kind of, range bound. And if you look, I mean, look at where we're at. Look at where we were, 6 weeks ago. We're pretty much the same place we were the last week in October. We're there, right? We're back there. So over the last 2 months, the S&P's uptrend has kind of stalled out, and we're sort of in this sideways period. It could end up being a major topping pattern, right? This could be a complex head and shoulders type of structure, but that's only valid as a topping structure if we would have a valid break below 65.50. So below 65.50, I think would confirm that as a topping pattern and be a pretty bearish sign for the equity markets. On the other hand, resolving this to the upside, which means breaking out above the October high, which would clear this range with the momentum improving. If the RSI can push above 60, ideally get to that overbought region as we break out, that'd be a very bullish sign. That would basically say, no, this isn't a topping pattern. We're back to making higher highs and higher lows. I think that'd be very bullish. In the interim, for between 65.50 and 6,900, I think we're kind of neutral, right? We're sort of in that yellow light kind of period. So, thinking of this kind of, the index as a traffic light, and recognizing that, again, if you describe what you're seeing as super bullish or super bearish, I think if you take a step back from your monitor and just look, I mean, this is definitely a different market from what we had in July, August, September to what we're seeing in Q4. Q4 is more sideways. Q3 was definitely an uptrend. I mean, clearly, undeniably an uptrend of higher highs and higher lows. Q4, October, November, and now December is more of a sideways trend. This is more of a wait and see kind of market, I would think. So, if I'm long things, if I'm long the S&P, which I certainly am through a number of ETFs, I don't see enough reason to be really bearish or sell as a trend follower because we're still holding support. A break below 65.50 would probably cause me to make some changes. If I'm bearish and we break above 6,900 on stronger momentum, I don't know how bearish I want to be if the market's breaking out, making higher highs and higher lows again, which is what we saw back here. But in the middle, I'm happy kind of waiting patiently for the market to communicate to me what's in store, what's coming next. So kind of thinking traffic light for the S&P right about now. Those are the levels that make sense to me. Watching the RSI, watching those levels that I shared with that traffic light. That's kind of the way I'm thinking about it. Breadth ticked higher today. So notably for now, the S&P percent of stocks above their 50-day holding just above 50%. That's pretty encouraging. In the short term, holding that I think is pretty important. The longer term measure of breadth is stocks versus the 200-day moving average. We're right at 61%. So we held 50% in mid-November as the market pulled back in the first half of November. I think that's a pretty encouraging sign in terms of signal that we're not breaking down and the market's not confirming a top yet. I would say long-term breadth indicators like this one remaining in pretty good shape is probably a good argument for that. I'd highlighted Dow theory in the month of November, and I highlighted that because both the equal-weighted S&P and the equal-weighted NASDAQ 100 did make new swing lows mid-November. This is a modernization of what Charles Dow wrote about in the early 20th century, looking at Dow Industrials and the Dow Railroads, looking at two main pillars of the economy to see if they're in agreement. in agreement. I think a modern version that makes sense is looking at the equal-weighted S&P and the equal-weighted NASDAQ. You're kind of considering the old economy versus the new economy by doing it in equal weight indexes or ETFs. You're stripping out the overly large and overweighted, I would argue, impact of some of the mega cap growth stocks, and you're more looking at the entire forest for the trees. If both of these would break out in the month of December, again, I often think about it as sort of a disproving a thesis, right? How bearish do I want to be if the equal-weighted S&P and equal-weighted NASDAQ are both breaking out? Because what that would tell me is it's not just Alphabet or Apple that are looking good. That means that the equal weighted indexes, that's telling you more about the index as a whole, right? The members of the index, the members of the S&P, the members of the NASDAQ are doing very, very well. And so I think that is an important chart to watch, particularly if you're bearish here. Look for signs that the evidence isn't bearish anymore. And again, I'm seeing more neutral evidence as opposed to really bearish evidence, which is what early November, things looked pretty, mid-November, things look really negative as we see a lot of breakdowns. We see breakdowns in breadth. Now with the mid-November to early December, it's not as bearish anymore. Is it super bullish? I don't think so from a trend following perspective. That's what breakouts would tell us, but we're getting closer to where that could happen. Now, another change that we've observed here in the last couple of weeks is volatility coming in. So the VIX is now down in the mid-teens. That means the options market, as I mentioned, pricing in very minimal changes one day to the next. That's exactly what we're seeing so far this week versus in previous weeks where we would see 1 to 2% changes in the S&P on an average day. Bitcoin continuing to follow through. Yesterday, we pushed above 90,000. Today, we're pushing above that Fibonacci level we've been highlighting, which is around 93,000. I think that's one of the more bullish things you could see, certainly on this chart, would be a break above 93,000. That would get us back to sort of the middle of this Fibonacci framework based on the major highs and lows so far in 2025. To complete this bullish rotation, if you look at the most recent sort of significant breakout after a downturn, you have to look back to April and May. And what you had was you stopped making lower lows. We started making higher lows and higher highs. We stopped being below moving averages. We broke back above it, notably breaking above the 50-day moving average here in late April. The momentum changed, right? So instead of the RSI being below kind of 20 to 60, it pushed up and it was between 40 to 80. And so that break above an RSI 60, I've often found can often be a really good sign of a change in momentum characteristics. And so we've had a couple of those boxes checked, and then getting an RSI above 60. The 50-day moving average is way the heck up here at 100,000. So that's another, right, 7,000, 6,000 above current levels. But, one by one, we're apparently checking that, recovery box on the chart of Bitcoin, something we'll certainly continue to follow. Changes we're observing now in the month of December, now coming out of the Thanksgiving holidays, defensive sector starting to come in a bit. And I think that's one of the more encouraging signs we could look to as well. In a bearish environment, one of the big signs that you can look for that tells us investors are getting defensive, which tells you investors are no longer optimistic and they're trying to just protect themselves from market downside. One of the things that has been a great indicator is the improvement in defensive sectors. And I think relative strength is a great way of demonstrating that. So here we're looking at utilities, healthcare, consumer staples, and real estate. Each of these data series show you the relative performance of that sector versus the benchmark versus the S&P 500. All four of these, the relative strength was improving first 3 weeks in November. Starting last week and now into this week, we're seeing all four of these start to rotate lower. So if these relative strength lines continue to trend lower in December as things like Dow theory are breaking out, that tells you we're back on offense and tells you investors are a lot more optimistic than they were a couple weeks ago. Apple making a new all-time high today. I just want to throw this in here to celebrate the fact that it's happening. Are many of the Magnificent Seven stocks making new 52-week highs today? They are not. But Apple is one that definitely is. It did close lower. It did close below today's open and below yesterday's close. But on an intraday basis, it did tick to a new all-time high. That puts Apple around $4.2 trillion in market cap. The RSI has been overbought and just barely coming out of that overbought region. And if you look back on the chart, you see a bunch of times since the end of July where we've seen a breakout. We've seen the RSI become overbought. It comes out of the overbought region, and that's sort of your short-term pullback. A lot of cases to the 21-day EMA that happened again here in early September. here in late September, late October, mid-November, and now happening again. So could be sort of that pullback. In previous pullbacks, we pulled back to the 21-day EMA. The RSI has gotten down to around 50 before we recovered. I would be looking for that sort of move if we do see a pullback here through the remainder of this week. Amazon, worth noting, a shooting star candle popped up yesterday. That's where you're in an uptrend. You have an open, you trade higher, you close back toward the lows, minimal lower shadow, long upper shadow. That's called a shooting star candle. Implies the next 1 to 3 bars are more likely going to be lower. Sure enough, today pushing down. So that's after bouncing essentially off of the 200-day moving average, pushing up here almost to 240, and now potentially rotating back down a little bit. I'm watching the 50-day around 230, 225 as an initial level to watch if we do see any further deterioration through the remainder of this week. Microsoft bouncing lower here. Just last week, we had bounced and accelerated off the 200-day moving average. Today, we're kind of rotating back down to there. The RSI has been below 50 for the last 5 weeks, so this is not a great chart. This is making a pattern of lower highs and lower lows. And if you look at what happened now in the last week, we bounced off of an expected level support, the 200-day moving average. We bounced right up to a descending 50-day moving average, and now that's the descending 21-day EMA. That's where we stalled out here in early November. Kind of did the exact same thing, which implies the next rotation lower, maybe a break of the 200-day coming shortly. We'll keep an eye on that as well. Netflix, literally almost to the penny, testing the 61.8% retracement. We've shared this chart a number of times. Netflix, the chart of Netflix in 2025, I would argue a perfect case study in the benefits of Fibonacci retracements. The 38.2% level, the 61.8% level, also the 50% level, all ending up lining up very well with key support and resistance levels over the last 6 months. And so it's a great reminder that after you have a big run higher, like you saw from April to June, you put the Fibonacci retracement there, just give you some objectives. If you're a swing trader, these are levels where you could take a contrarian bounce kind of trade and bet on a mean reversion. If we're above it, you'd expect to bounce off of there. If we're below it, you'd expect resistance there. So what this means is as we approach 61.8%, maybe there's a bit of a counter trend bounce similar to Microsoft. The last bounce stalled out right at the 21-day EMA, RSI remaining below 50. Primary trend is down on Netflix. It's an ugly chart. I would argue getting uglier. Couple semiconductor names having really good days today. On Semiconductor is one. I'm going to show you Microchip here today, MCHP. Gap down in November creates this sort of move. We're going to call this an island reversal. It's not a perfect one, but pretty close to me. The gap down, the gap up. So this is kind of like an island. If you're looking on a map, overhead map, sort of like an island geographically. And that is usually a pretty good reversal signal. That gap back above 57 sort of completes that rotation. That gap also takes us above the 200-day moving average. So, I don't have a position right now in MCHP. If I'm trading a name like this, that could be where I take an initial position on that gap higher, confirming that island. The 200-day, the lower or the upper end of that gap, that's probably my initial stop, because I'm basically saying I might bet that if I was taking a trade, the bet would be this gap is the beginning of a further recovery. And maybe I'm looking for resistance here at some of these previous levels, but I'm betting on this, continuing further, at least for a short while. But if we would break back below the 200-day moving average, that thesis is no longer correct. So good reminder, friendly reminder, regardless of what the chart tells you. I always tell people when you are putting an initial trade on, that's when your exit strategy needs to be clearly laid out as well. What too many people do as they get started is they sort of put the trade on and then they wait for something to happen to figure out the exit strategy. And that's kind of like flying an airplane, waiting for the engine to cut out and then figuring out what you would do in that scenario. If you've ever tried to fly an airplane, I'll tell you what you do. You have it all sketched out ahead of time. You're always thinking of contingency plans and redundant systems and what would happen if the propeller would fall off by some random, completely unlikely scenario. What would I do? And you're trained to just evaluate the conditions, go through the checklist, take the steps that need to be taken so that you can get the plane down safely. So the lesson there is you don't wait for the propeller to fall off, which again is highly unlikely in most airplanes, to be honest with you. But if it would, it's like you already have a plan, right? You don't have to think about, oh, what do I do? You just immediately kick into the emergency plan that you've already laid out, and you have it all ready to go. So don't do anything different with your trades, with your investments, right? Have a good strategy, have a good exit strategy, be ready to kick it in. So when you set a trade on a chart like MCHP, clearly set out right up front what would tell you were wrong and where you might want to start, changing your position and changing your perspective. That'll do it for today. I'm Dave Keller. Thanks for joining me here on my daily market recap show. As always, please take a moment and drop a question in the comments section below. It's great to hear from you. And also, will give me some questions maybe to feature in our next all mailbag episode. We'll be back tomorrow on Thursday with a market recap. In the meantime, have a fantastic evening. And remember, it's always a good time to own good charts. Take care, folks.